This right here, this candle right here, is a mitigation block. Now, I don't talk too much about it, but it is basically the opposite of a breaker, but they are still both mitigation in essence. Now, we have a high, a low, and a higher high. No, lower high. You see that? That low between it is a mitigation block. If this high here was taken out with a higher run here, then that would be a bearish breaker. Bearish breakers are much more stronger in terms of resistance than a mitigation block. A mitigation block can be traded through. So in terms of how I use mitigation blocks, I typically side with using them as targets more so than entry, because they can be traded through. Breakers are kind of like, they're pretty formidable in the path of price action. It doesn't mean that they can't go through them. It doesn't mean I've never had a losing trade using a breaker, because I have. But mitigation blocks are better used for targeting purposes. I was using this one here with the expectation that the NASDAQ could try to gravitate towards that. If it were to go any higher, this small little fair value gap there, and obviously the buy side above it. So knowing where the market's going to go to, that's a directional bias. Listen, at some point, folks, unless you trade options and you're delta neutral, you have to have a directional bias. There's no way around it. You have to. Otherwise, you're writing options. We don't need to predict the future price direction. Well, yes, you do. If you want to be profitable, or at least consistently profitable, like, you have to have an understanding of where the market can gravitate towards. If you don't have that skill set, you will not be consistently profitable, period. End of story. There's nothing else to discuss. I wanted to see us gravitate towards this mitigation block. It would be above the relative equal highs here that had already been cleared through here, and we consolidated. Markets don't top like that. Okay, and it was more likely that we're going to expand higher. It did. It reached into the mitigation block. It actually closed right on it. So that's rather decent, isn't it? So ahead of the week open, we were expecting price to go higher. And we have this candle right here. Now, on this candlestick chart here in the lower left-hand corner, this is a daily chart of the NASDAQ. So if we see this down close candle after, if you look at the weekly chart here, there's a small little fair value gap right in there. That's this one here on the daily. So the market traded higher there. And then we have this down close candle, which is right above and digging into this down close candle. This is an order block. It's bullish. This is a propulsion block. Propulsion blocks are order blocks by themselves, but the way you differentiate what they are and how they're used is this down close candle digs into a previous down close candle. So an order block that has another order block that digs into it. Propulsion blocks, you never want to see a closing price below mean threshold. Mean threshold on an order block is the 50% level. We wicked down through it, but then closed here. This one here, we wicked down through it and closed right here. We wicked down through it and closed up here. So yes, we had the movement through the mean threshold, but we didn't close below it. So that still keeps this down close candle valid as a propulsion block. Friday, Thursday, Wednesday, Tuesday, Monday's trading. All of this movement here was just returning back into this gap, this tail on this candlestick. We treat wicks and tails on candlesticks as gaps. Midpoint of that gap, or tail on that candle, is consequent encouragement. Extended out in time, you can see that's exactly where we were trading on Monday. It did not violate the rules that make a propulsion block invalid. Market closes here, and now we open the next day. We open, trade down, rally back up, and have an up close. So the next 2 days we had news. We had pretty good economic calendar events for the rest of the week, and it sent price parabolic above the relative equal highs. So the draw on liquidity is the weekly chart mitigation block. So this movement here, this was fully expected. We were expecting this bullishness in higher prices on NASDAQ. We were expecting it in ES as well, E-mini S&P. But we look for things to start or instigate a price rally higher or a price decline lower. And we frame it on the basis of where are we at right now versus where is it likely to go. So if we think that the price is going to gravitate up to this area here, if we start the week here, Monday, and then Tuesday, and Wednesday, and Thursday, and Friday, we expect each daily candle to gravitate towards that level. Even if you didn't pick that level, if you felt that this fair value gap was a reason to keep going higher, that's fine. There's nothing wrong with that. But this mitigation block is below that fair value gap. And if you were using the relative equal highs as a draw on liquidity, there's nothing wrong with that either. Remember, the only thing we're doing is primarily looking for the expansion either higher or lower on the weekly candlestick. That sets our bias for the week. So is it more likely to see where price was consolidating here? Is it more likely it's going to drop down after we've already went into this fair value gap here? We already did that. And then we consolidated here the previous week. And then we start a new week here, trade down a little bit, and then reject it, which is all that rejection is based on this consequent encroachment, this daily candle right there. That's where the low of the week was formed. So this is primed to just obviously expand higher, aggressively above these relative equal highs on the daily chart. So there's buy orders resting above that. Markets don't top like this, folks. They don't do it. And since the weekly and the daily chart are showing this pattern, it's more likely to go higher, especially since we were bearish on dollar. Not just bearish a little bit, but we were exceedingly bearish, expecting it to reach for a larger pool of sell-side liquidity. So if that is the case, that means it's definitely a risk-on scenario, meaning all assets have the likelihood to go higher. Euro, pound, gold, all other asset classes are free to move higher because it's risk-on. And we saw a huge risk-on event this past week where most asset classes went up while the dollar crashed. Over here on the hourly chart, I want you to notice this little shaded area here. That's the propulsion block. That's this whole range here, but visible on a hourly chart. So we have relative equal lows here. We drop down into it. We trade above this short-term high right there. That's all it needs to do. That's a shift in market structure. It doesn't need to close above it. It just now sets the thing in motion that we're going higher. Doesn't mean you can't have retracements, but look where it retraces. If you take this propulsion block right here and you divide it in half, that's mean threshold. That's what this drop was going to right there. It's going right there, and it's also cleaning up these smooth edges in the bodies. Wait a minute, that's not smooth edges, ICT. Look at this wick right here, or this tail, and look at this right here. Look at the bodies. The bodies tell you the story. That's the narrative. The wicks do all the damage. That's the stuff that everybody gets hurt by. You get stopped out, and you don't want to go back into the marketplace. That's their purpose. Reading price action with a time-based chart and focusing on the bodies of the candles. If you just saw these right here like this, and there was no wicks or tails on your candlesticks, if you took that completely off your chart, this would look like smooth edges. And that's all this was, trading down into mean threshold, which is the entire range from high to low. Split that in half. That's this level right here. That's occurring right in this level, digging into it after we had a shift in market structure. So what am I saying here? At this point, right there, that's slightly higher high than this one, because we've had sell side taken there. Now we have buy side. We're bullish. So we have now met the minimum criteria for high probability directional bias. So now we can absolutely predict higher prices. We can trust that higher prices are likely to go where? Up in here, this mitigation block. So if we're looking for a 15,693 level, and we're down here, and we drop down to mean threshold, at that point, does the market want to rally away from it? Sure looks like it does to me. Tries one more time, digs into it, but look where the bodies are showing. They're showing that it's respecting that propulsion block right there. We've already did the damage to going down into it, and here bodies are supporting the high end of the propulsion block, that shaded area. And then we want to see, does the market want to rally? And from here, as soon as we get these candlesticks showing this, and this candlestick closes, the next candle here, and it drops down and touches this, the high of this blue shaded area, which is this candle, that range on the daily chart. We're working with the hourly chart here now. I know that we're likely to go higher. Where? We have all this sell side imbalance, buy side inefficiency. So basically this candlestick's low. And then we have the buy side above this high here. There's buy stops resting above that. But this also is another pattern. It's a breaker. But if we're expecting price to go up to this blue line, and we're seeing evidence that all these things down here, stops have been taken, it's swept, we have all these bodies here, which is relative equal lows. Forget the wicks, go back into the bodies. They're telling you the narrative. That's the storyline. That means they're going to want to sweep through it. There you go. It's happening right there. So when this is a full bearish candle, I would be buying that. You probably wouldn't. But I'm leaning on this being a propulsion block. This is an order block that's already confirmed that it is. We broke through this candle's close right here, which is a rejection block. It's showing a willingness to want to go higher. I don't need this high to be taken out. It's went above this one here while I'm bullish. This down close candle is a propulsion block. So that range I'm shaded here, I'm putting that and transposing that onto an hourly chart. So I'm watching price action on an hourly basis, how it performs. See, when I have the high, the low, and the mean threshold price point of that candlestick right there on the daily chart. And I have on my notepad, daily propulsion block, high, mean threshold, low. So I'm watching price when it's meandering around in here. I'm watching time of day and how it responds at those specific levels, because I'm predicting, I'm anticipating, I am not reacting to anything. The only time that I react is if I'm wrong and I see the evidence in price action that I'm offside or am likely to become offside. Then I'm going to react to that new information and say, okay, I got to bail on the trade. That's the only permission that you're ever going to get from me to react to price, because everything else, we are absolutely predicting price. You are doing that. You're predicting the future. That's what this is. It's future. It's why they call it futures trading. It's in the name. And why are you arguing saying you're not trying to predict the price, or you shouldn't be trying to predict the price? You are. If you are bullish, that means you are predicting higher prices. If you're bearish, you're expecting and predicting lower prices. How are you reacting to anything? If you're reacting, it means you're chasing price. I'm not chasing price. I'm waiting for very specific things where price will walk into my crosshairs, and when it does, it's going down. I'm going to pull the trigger, and I'm getting my entry. I have 81 ways to get in there. Trust me, I'm getting in there. If trading was like a cat burglar, I'd be the best one at it because I can get in that bitch. So we have the mean threshold here, rallies back above, relative equal highs have been cleared here, and now the bodies are showing that there is an interest in seeing no further decline. Well, how do I know that? Because the bodies are not closing inside that blue shaded area. It's already done the work of doing what? Trading down into mean threshold. One more time, shifting higher. So market structure is now, again, one more time, bullish. So where's their inefficiency above this price point right here? When this candle closes, this one right here, when it closes, where is the draw on liquidity from that price point there? Well, you have this short-term high. Well, and versus that, I don't care, because my focus is on, it's going to roll right back up this inefficiency, which is a SIBI, sell side imbalance, buy side inefficiency. It's a classification of a fair value gap. But then once it goes to this level here, it's not done, in my opinion, because my focus is up here. So I'm reading the tape. I'm watching how it delivers all through here. Once it gets to this price point here, I'm going to anticipate. I'm going to predict. This is where I would be in my live stream. This is where I would be in my recording of my execution. I'd be typing out big range candles incoming. When it gets right here, right to that price point low, right there, I would be typing out, we're going to anticipate, we're going to expect, we're predicting, we're not going to be surprised by large up close candles. Why? Because it's going to make a quick run for the liquidity resting above this high. That's what the algorithm does, folks. So we have an ICT bullish breaker here. These are the instances where you see classic support and resistance ideas come in. And this right here, this is one of those videos where someone's going to come back in the future and say, see, all ICT is doing, he's showing you classic support and resistance, and this is nothing new under the sun. No. No, trust me, we're going to go deeper. I want you to think about why this level would be sensitive anyway. I want you to think about how the market from this high traded down and then traded up and then through it. What does that make this range from this low to that high. Once we broke out above this high here, which is what we were anticipating, we're not breakout traders. We're not reacting to price. We want to see that. But what makes this a very specific range? This becomes a balanced price range. What makes it balanced? We had a high. We traded it down. So sell side delivery has been offered, not sell side liquidity. Sell side delivery is any price run from a high to a low. We have had sell side delivery from here and here, that range. Now, when we run right back over that entire range again, from that low up to that high, which is what we're doing here over time, as soon as we break through here, this high to that low is now a balanced price range. There is absolutely no reason to anticipate, expect, or want to see price come back down below that low. Why? Because the focus is up here, folks. We're expecting, we're predicting, we're anticipating the market to footprint its ass right on up to that level. We want to see that. We're expecting that. So where is the mile markers at going to be? Where's the rest stops along the way? Well, when the market runs above this area here, it's more likely to do what? Treat this level here as a breaker or a springboard to go higher. Why? Because this high has a lower low that's higher than this low over here. I'm not showing it to you because I want you to look at the commentary from yesterday. So the market comes back down. Does it wick through that high? Absolutely. And that's permissible. That means it's allowed. We expect that. We anticipate that. We're not reacting. We're not scared by it either. Look where the bodies close. Right here. And it opens right there. So there are wicks that are going down into this buy side imbalance, sell side efficiency, which is BISI. It's a fair value gap. But what specifically stands out here? What is that? What's the segment between this high on that candlestick right there to this candlestick's high? What is this area? What is that? It's inefficient. But then when we see this candlestick here trade down into it, it erodes some of this inefficiency. So it starts from here to here. This area here is a breakaway gap. The reason why it becomes a breakaway gap and why we would never expect the depth of market, the DOM, even if there was bigger orders below the marketplace here, okay, if there was a stacking of orders below that were really large, okay, big interest to draw into that area down there, they're not going to go down there. Those things are not going to fill. What? Yeah, because it's going to go higher. Because this area is going to stay open. Why should it stay open? Because it's running out of this range right here. It's already done the work of digging into this daily propulsion block. So this is why you cannot look at one candlestick chart, one time frame, and follow the narrative. You can't be done, folks. Do we get that confirmation with the body staying at or above this high here? Yes. Does this stay open? It's not trading back down into it. You would never expect this if you're my student. You're never expecting this area to be printed into anymore. But I promise you, and I've seen it, traders are looking at those things and they're expecting it to go down because they think this is an inefficiency now because ICT's talked about it. No. So the market should be rallying higher. Where should it go? Well, where's the next draw on liquidity? Near term. Yes, this is it up here. But what above this high exists in terms of liquidity? Buy side. So the market right here has buy side. The market draws up into it. What happens before it gets to this run right here? Right here, this run right there. What happens? You see this wick right here? You see that wick? Half of that is what? Consequent encroachment. Interesting how it goes right down to it right there. Interesting how we have a gap right there with a wick. So if we have a gap like this with a wick, always trust and allow for it's likely to go into this consequent encroachment, not just fill in that gap right there. So it can trade down, even though it goes over top that gap, the candlestick's high right here. If it went through that live, I would not be unsettled by that. I would not be scared by that. I would look for this candlestick's wick right here. The midpoint, which is consequent encroachment, we treat that as a gap. The market goes right back to it there. Then what does it do? Right back up here. All right, so when the next candle opens up, I would be looking at that and saying, okay, now I want to see it start expanding towards this high here. and I want to see it aggressively run through it. I want to see speed. Well, we get it there. We come back down in. What is it doing? It's working inside this wick, which is what? A gap. We do gradients on wicks. 75% of the wick, 50% of the wick. We never want to see, in this case here, lower than 50% or consequent encroachment. So any respect of this wick should be limited to the high, 75% of the wick, and then consequent encroachment, which is half. So in my mind, when I'm watching price action over here, I don't want to see it go below half of that wick. Go over here, look what it's doing. It's going down, but it won't breach on a closing basis midpoint of that wick, which is consequent encroachment. That's tape reading. So the market does what? It rallies above this high here. What's above that high? Buy side, buy stops. Someone is chasing that lower when it's green. This is an hourly chart. So inside that weakness in that hourly candlestick, someone's going short. Where they're going to place a stop? Right above that high. So the market does what? It gravitates up to it here, and we drop down, respecting consequent encroachment there, and we rally. What do we do now? We start expanding aggressively towards that weekly mitigation block, this level right here. And we trade up into that level there, and then we consolidate. Markets do not top like this. Once we trade through it here, right there, what does this area or fractal and price action become? The same thing I told you this becomes, a balanced price range. From this candlestick's high here, up to this high, then back down. Once we clear this high here, this whole shaded area becomes a balanced price range. I am not concerned about price wanting to, at any time up here, going back down inside this range. So for stop loss management, your stop loss can be anywhere in this range and feel pretty confident that it's not going to get there. So how would I do it and sleep good at night? 75% of that range, if my stop is below that, I'm comfortable with that. Some of you get crazy about how I'm using my stops. Sometimes they get really close to what you might be scared to do at the time. When you're watching my executions and you're seeing it, you're thinking, man, this is crazy. I wouldn't feel comfortable, because you just don't know. I'm teaching you right now. These are long videos. These are very dense, very demanding of your attention to learn. And that's expected. I didn't tell you it's going to be easy and watch a video and you know how to do it. I warned you ahead of time. It's going to take a lot of work, but it's something that it's worth doing, because once you have this skill set, nobody can take it from you. They can make jokes about all they want, but they're never going to be able to do what you can do once you master this.